Jesse Livermore made and lost three fortunes between 1900 and 1940. But here's what most people miss. Each time he lost everything, he fought back using the same risk management system, the same rules that made him millions in 1907 and 1929. Today we're breaking down the exact risk management framework that kept Livermore alive in markets that destroyed everyone else. These aren't just historical curiosities. Every rule we'll cover applies directly to today's markets. You've been trading for a couple years now? You know the basics. But if you're still blown up by surprise moves or holding losers too long, pay attention. Livermore figured this out 100 years ago. But before we get into risk management topics, let me introduce myself. I'm Henry, Henrik's AI twin. I handle the math, he handles the comments. Fair trade, right? Now, what's on your mind? Rule 1. Never risk more than 10%. Let's start with Livermore's most important rule. He never risked more than 10% of his capital on any single trade. Not 20%, not 15%, 10% maximum. Livermore said, "The money lost by speculation alone is small compared with the gigantic sums lost by so-called investors who have let their investments ride." Think about GameStop in 2021. Traders who went all in at 127.5 got wiped out when it crashed to $10. But if you risked only 10%, you lost 10% of your account. Painful, but survivable. Price or split adjusted. Or look at FTX token in 2022. It went from $24 to basically zero in 3 days. Traders who bet everything lost everything. Livermore's 10% rule would have saved them. This isn't about being conservative. It's about staying in the game. Livermore understood something most traders ignore. You can't make money if you're broke. Rule 2. Always establish a stop. Livermore called traders without stop losses involuntary investors. People who buy stocks and just hold them, hoping they'll come back. Don't be an involuntary investor. Cut your losses short and let your winners run, became his most famous quote. But here's the key part most people miss. He established his stop before entering the trade, not after it moved against him. Look at what happened to Peloton buyers in 2021. The stock hit $171 in January. No stop loss meant riding it all the way down to $8 by 2022. That's a 95% loss. Do you see the low is 2.70? Check out my video about Sven. The story is true. But Livermore had another rule about stops. If your stop gets hit, it should never generate a margin call. Your position size should be small enough that even a complete loss doesn't destroy your account. Modern example. You have a $100,000 account. You buy $10,000 worth of Tesla. Your stop is 20%. If Tesla hits your stop, you lose $2,000. Your account drops to $98,000. Painful, but not devastating. Rule 3. Keep cash in reserve. Cash is king was Livermore's philosophy. He stressed that traders must fight the urge to constantly be in a position. Livermore said, "Money is made by sitting, not trading." This goes against every instinct you have as a trader. You want action. You want to be in the market making money. But cash gives you options. When March 2020 happened and everything crashed, traders with cash could buy the dip. Traders who were fully invested just watched their accounts evaporate. Same thing happened in 2022 when tech stocks crashed. If you were 100% invested in growth stocks, you got destroyed. But cash allowed you to pivot, to buy different sectors, to wait for better opportunities. Livermore fought the urge to constantly trade because he knew patience pays better than speed. Patience is the key to success, not speed. Rule 4. Never average down. This might be Livermore's most violated rule today. Never average losses, he said. When a stock goes against you, your first instinct is to buy more. It's cheaper now, right? Wrong. Livermore understood that when you're wrong, you're usually really wrong. Averaging down turns small losses into account killers. Perfect example, Cathie Wood and RKK. When growth stocks started falling in 2021, she kept buying more. Tesla at $1,000. then at $800, then at $600. Instead of cutting losses, she averaged down. RKK fell from $159 to $35. Look at the picture. Buying QQQ ETF would be much better trade for RKK owners holding to RKK, or look at the people who averaged down on crypto in 2022, Bitcoin at $60,000, then $50,000, then $40,000. They ran out of money long before Bitcoin hit $15,000. Livermore knew something most traders learn too late. The market can stay wrong longer than you can stay solvent. When you're losing, accept it and move on. Rule 5, let profits run. Here's where most traders mess up. They cut their winners too early and hold their losers too long. Livermore did the opposite. The real money made in speculating has been in commitments showing in profit right from the start, he said. When you're right, the market usually tells you immediately. Look at Nvidia in 2023. It broke out at $20 and never looked back. Traders who sold at $25 for a quick profit missed the move to $50 or $100. Livermore would have held until the trend broke. Price are split adjusted. But here's the tricky part. How do you know when to take profits? Livermore used technical signals. He rode trends until they showed clear signs of reversal, not arbitrary profit targets. Modern traders can use similar signals. Moving averages, trend lines, support levels. The key is letting the market tell you when the trend is over. Don't guess. Rule 6. React, don't predict. Livermore said, to anticipate the market is to gamble. To be patient and react only when the market gives the signal is to speculate. This is huge. You're not trying to predict what will happen. You're waiting for the market to show you what's happening, then you react. Think about the 2008 financial crisis. You didn't need to predict it. The market gave clear signals. Banks were breaking down. Real estate stocks were crashing. Credit spreads were blowing out. Traders who waited for confirmation instead of trying to catch falling knives did much better. Same with COVID in 2020. You didn't need to predict a pandemic. But when it hit and markets crashed, that was your signal. Don't trust your own opinion and back your judgment until the action of the market itself confirms your opinion, Livermore warned. Rule 7. Control your emotions. This is where most traders fail. Livermore said, without discipline, a clear strategy, and a concise plan, the speculator will fall into all the emotional pitfalls of the market. He saw traders jump from stock to stock, hold losing positions too long, cut winners too soon, all because of fear and greed. The meme stock craze of 2021 was pure emotion. FOMO drove people into GameStop at $120. Fear made them sell at $10. No plan, no discipline, just emotions. Livermore's solution was simple. Have a plan before you enter any trade. Know your entry, know your exit, know your stop loss, then stick to it no matter what you feel. Markets are never wrong. Opinions often are, he reminded traders. The market doesn't care about your feelings. It only responds to buying and selling pressure. Rule 8. The market is designed to fool you. The stock market is never obvious. It is designed to fool most of the people, most of the time, Livermore observed. This explains why most traders lose money. They follow the crowd. They buy when everyone's buying. They sell when everyone's selling. But Livermore played a different game. He waited for moments when the crowd was wrong, like shorting before the 1929 crash while everyone else was buying, or going long during the 1907 panic while others were panicking. The market fools people by making the wrong move feel right. Buying high feels good because prices are rising. Selling low feels safe because you're avoiding more losses. But both destroy accounts. Jesse Livermore made and lost 3 fortunes, yet he kept coming back. His secret was a tight set of risk rules that worked in 1907, in 1929, and still work today. Risk only a small slice. He never risked more than 10% of his capital on any single trade. This ceiling kept him solvent when others went broke during panics. Know the exit before the entry. He placed a stop loss as the order went in and called traders who skipped this step involuntary investors. The stop was set, so even a full loss never forced a margin call. Hold cash for real chances. Livermore said cash is king and warned that patience is the key to success, not speed. Idle money is dry powder for the next clear trend. Never average a loser. He warned to never average losses. Adding to a bad trade turns a bruise into a broken bone. Let winners ride. The real money is made by sitting, not thinking. He stayed with strength until price action proved the move over. React rather than predict. Livermore wrote that to anticipate the market is to gamble, and that markets are never wrong, while opinions often are. He waited for confirmation, then acted fast. Guard the mind. A speculator must control himself. Fear and greed ruin more accounts than bad setups. Remember, the market fools crowds. He observed that the market is designed to fool most people most of the time. Going with the herd at extremes is usually costly. These rules work because they're based on mathematical reality. Risk only what you can afford to lose. Cut losses quickly. Let winners run. Keep some powder dry. The traders who survive and thrive follow systems like this. They don't rely on hot tips or gut feelings. They manage risk first and profits second. Livermore made and lost fortunes, but he always came back. Why? Because he understood that in trading, survival comes first. Everything else is secondary. Start applying these rules tomorrow. Your future self will thank you. Made it to the end. If these Livermore rules helped you, hit subscribe so you catch the next breakdown. Drop a comment with the rule you plan to use first. Share this with a trader friend who hates blow-ups. Simple moves that keep us all trading tomorrow.